Thanks for joining today's webinar, Trends and Tips on Early Stage Fundraising. Some logistics before we dive in. The webinar will be 45 minutes. It's recorded and we'll email you the recording within 48 hours, excuse me. We'll open it up to Q&A at the end for the last 10 or 15 minutes. So please put your questions in the chat, whether throughout the presentation or at the end. Quickly, a bit about DocSend. It's a way to share and track documents securely. It's great when fundraising because whether you're sending your pitch deck to investors, you can actually see if they view it, how long they view it, where they focus the most, so that you can strategically follow up and craft your narrative to where they're most interested. So no more attachments or having no idea if they viewed it. And why are we at DocSend have this interesting data to share? We have a research arm in our marketing efforts that we coined DocSend Startup Index, where we survey our community and over 19,000 customers about their fundraising experience and marry that to our product usage data. So the documentanalytics that you have access to as a DocSend customer, we aggregate that across pitch decks to identify trends and best practices. And through this research, our goal is for you as a founder to put your best foot forward when fundraising. So we share this live set of data on a weekly basis through Twitter and our newsletter, but also aggregate it up into 5 annual reports. One of which is launching tomorrow on the funding divide, which highlights biases that we see in gender and race when it comes to fundraising. I'll drop that pre-registration link in the chat if you want to be one of the first to receive it tomorrow morning. But today's webinar is on trends that we found in pre-seed and seed fundraising. So I'll pass it to our speakers to introduce themselves and dive in. Russ?
Hey, thanks, Cassie. I'm Russ Heddleston, one of the co-founders at DocSend and was previously the CEO. We sold to Dropbox a couple months ago. The plan there is they're just going to help us accelerate the mission and vision for DocSend, and it'll just make DocSend even better over time. So stay tuned for that. And historically, I've been a software engineer and product manager at a number of companies, including previously Dropbox, Trulia, Microsoft, and before this was at Facebook, and I sold my first startup, Pursuit, to Facebook in 2011. With that, I will turn it over to Youri.
Hey everybody, nice to be with you here virtually today. My name is Youri Doeleman and I'm a partner at Antler here in Amsterdam, the Netherlands. For those of you who don't know, Antler is a global early stage venture capital firm that works with founders from before even day one of having a new company. So pre-idea, pre-team, all the way through until the later stages of funding. My background is a bit global in a way. I grew up in Mozambique, later spent 3 years in Japan where I studied the Big Bang and other kinds of physics. And then I started my career actually with McKinsey in Norway. Spent a few years in Brazil as well, in Sao Paulo, and then came back to Amsterdam finally in 2015, and set up Antler here. Since 2019, we have one of our funds here based in the Netherlands, working with founders from over 30 countries. We have about 20 investments in our portfolio so far, ranging from health tech to prop tech, fintech, marketing technology, agri-tech, robotics, and more. And it's also part of this broader global Antler platform. So, we have a fund in the US, we have a fund in the Nordics, in Southeast Asia and Australia, and a few others as well. So really, if you're an early stage founder, we'd love to kind of get in touch and see if we can help you in any way, shape, or form. And obviously, given that we have all these various locations running our founder programs all over the world, we also have seen quite a lot when it comes to pre-seed and seed fundraising. In terms of all kinds of founder profiles, decks, and so forth. And so very happy to be a part of the discussion here today and exchange some learnings on the topic. Thanks for the invitation, DocSend.
Very welcome. Charlie.
Hi everyone, great to be here. Look forward to this webinar and fielding questions later. So my name is Charlie Pinto. I am a venture principal at Bling Capital. Bling Capital is a seed-focused fund. We lead seed rounds. Our focus areas are anywhere from consumer tech, internet mobile, marketplace, data, fintech, SaaS, automation, and we even delve into some frontier tech as well, and also some health tech. Bling Capital, in terms of where we focus, we help companies get to product market fit. And once we get there, we help them scale it. A little bit about my background. I was first a collegiate wrestler and then found my way into startups. Co-founded a company that went through Y Combinator in winter 2012. We exited in 2014. I've led product, I've led business development, and I also at Bling Capital lead everything from, or work with other venture principals as well with a lot of our portfolio companies. So that's a little bit about me.
Cool. Well, it's great to have you both here. So I think the purpose of the way we've set this up is that we've got some data from DocSend to hopefully ground the conversation. And then, Charlie and Youri are here to provide some, kind of on the ground commentary about that, how that matches up with their experiences and, make it more, real in terms of as a founder, like what's the market like and what are, best in breed investors like Charlie and Youri looking for, and how can you as a founder give yourself the best chance of raising money and getting back to building your company. I always say you just don't get credit as a founder for the time you spend fundraising. You get credit for building your company, but fundraising is a very important milestone, and the partner you pick for fundraising is incredibly critical. So before we get into that, I just wanted to jump over and show a couple things on aggregate investing. So we track for DocSend as well, just the total volume of investing, and we look at this year over year. And so when we look at the amount of investor deck interactions, interest from investors, you can see the purple line here, it's at an all-time high relative to past years by quite a bit. This is good for you as a founder. Investors are looking through more decks than ever before. In terms of time spent on average, investors are spending less time, so they're going through more decks, but faster. That's fine. They're getting more efficient. They're at fewer conferences, fewer plane rides, and they're just spending time going through and trying to find great founders. And then founders, the number of links they're creating, also an all-time high. So as a founder, you're going to end up having to send your deck to more investors to get your round done. A little annoying, but at least the market overall is vibrant and has never been stronger. And there's never been a better time to start a company and get funded. So those are all great things. We're going to talk through 3 different sections, the first of which is the importance of product readiness, because we have seen that shift over the last few years and what that means at a pre-seed and seed stage. So one question we often get asked, like when as a founder should I launch my company? Because oftentimes investors say, oh, I'd like to see more traction. So we looked across thousands of companies that responded, and at the time of getting a pre-seed round raised, this is the breakdown of where their product was. So 11% no product, 19% launched, and then alpha and beta is most of it. So what you see here is kind of a bottling up of companies waiting to launch for pre-seed, and they're still able to get funded. And then when we look at the seed round, we actually see a shift from alpha and beta over to launch, but still only 39% at the seed stage have a publicly available product. So I mean, this is a big important decision as a founder, like when to launch and like what to say, the level of product of that. But here again, very few companies have no product. So the answer is you probably need some sort of product. Maybe Charlie, if you want to start, like how do you think about as a founder, like what level of product readiness do you like to see, and like what does that depend on?
That come a lot from the Y Combinator ethos, which is they always tell you need to launch your product as soon as possible. You want to find that 90-10 solution. I think Paul Buchheit said that when he part of his background in launching what is now Gmail. You want to find 90% of the use case, which is 10% of the effort, and you want to launch as fast as possible. And the reason why is if you're not writing code and talking to customers, you're going to continue to be in that area of you're just trying to prepare the product for launch. And your product won't be anything without customer interaction with it. That gives you the feedback you need to iterate on your product and improve it, and then actually learn more about your customers, which is the most important part of the whole process.
So you'd advocate for both these rounds. Like you'd like to see more in the launched category. Like beta is probably like anecdotal, but you think it's a scary thing, but just get it out there because there's no better way to see.
Yeah, absolutely. I mean, listen, as a former co-founder, CEO myself, we didn't want to launch because we didn't want our baby to look ugly. But the reality is that you want to launch it, even if it's minor. You want to start getting customers to use it. And also now being on the other side of the fence, it's important for investors to see how you actually are able to quickly turn around. And so it's about that throughput too. So it's about taking that feedback from customers, writing code, launching a new feature update or fixing your product or learning from how customers are interacting with your product. which even if you don't have a lot of traction, shows investors that you have the ability, that you have the capacity in order to quickly iterate on the product and continue building.
That's fascinating. So you give founders extra points if they've got a product launched. And if a founder is like, well, we're going to launch it, it's like, launch it sooner.
I think that will depend on the founder. So I mean, listen, at the end of the day, it's like, is this a founder that's had a successful exit before? Have they launched and built the product in the past? That gives some historical knowledge. So you know yourself better than we know you. If you feel like you've launched and exited a successful product in the past, perhaps you can wait a little bit longer, and it pays to be in stealth. But if you're kind of just you're green, or it's your first time building and launching a product yourself as a founder, it pays to launch and to start building some customer feedback loops and building your product and figuring out if things work or not, because the product you initially launch with is probably not going to be the product that you end up being very successful with.
Yeah, that's a good point. There are a couple of good questions we'll loop back around to in the Q&A, but Youri, maybe first, how do you think about this? Any differences from Charlie?
Yeah, sure. So I 100% agree with the philosophy of getting to market as fast as possible and learning from real customer feedback. I'd like to nuance it though to the fact that some products take longer to develop, right? And so especially if you go into enterprise stuff or deep tech stuff, you're simply not going to be able to put out a fully functioning product in a week or 2 weeks, or even a month or 2 months. And so the question of what does it mean to kind of get that customer feedback in is then answered in a little bit different way, right? So for example, in enterprise, there are various things you can do, but one thing that I'm personally quite a fan of is if you can find a potential launching customer who is already investing the time to even discuss with you what the product should look like, and over a course of a few weeks you get a whole bunch of learnings in that can be some kind of a proxy for a product which is not yet completely launched. And so depending on the type of product you're building, the launch cycle varies a bit. The other thing I wanted to add is that some investors actually quite explicitly don't require this, right? And so Antler, where I am, is an example of that, because for us, when you reach our investment committee, we simply do not require you to have a live product, right? We actually have done 10 weeks of observation on your execution ability across all kinds of different fronts, which is what is our due diligence on you as a team. And that's the most important thing. And then as we, after our investment, work towards a seed round, we have a very sharp discussion around what level of product we want to launch before going for the seed round with those portfolio companies. But at the time of the Antler investment itself, we clearly don't require it. So you may find some investors who are like that, and that you should also tailor your story, I guess, based on what they look for.
Yeah, that's a great point. So I would say, like, for hardware enterprise, it's a little bit harder to have that MVP. And so the question is, like, what evidence can stand in instead of a fully launched public product? Do you care about LOIs, or for companies that do require more development investment before getting to launch? Are there any things? Is it just like saying, I had an enterprise spend 10 hours with me in the last 2 weeks, or do I need to sign a piece of paper, or is there a product you need to be able to poke around in, or how should they think about what to show if it's not public launch?
Yeah, this is a very common question, and the first thing that I always try to do is just play it back, right, and just say, look, just show me what you got. Anything is helpful. Give me numbers of people that you've talked to. Give me what type of commitment are they willing to put in now versus later. How much time have they spent with you? But you just need to go out and talk to a lot of different customers and get some level of commitment from them. And in the enterprise case, I always think that time commitment is probably one of the most valuable things you can get early on, because an LOI can be written in an hour or less, and if it's a friend of yours in a corporate, it doesn't really mean anything. Whereas if somebody in a corporate is actually spending dozens of hours with you, I mean, that's coming out of their very busy agenda, and that means that it's valuable to them. So that's a better indicator for me. But really, at the end of the day, it's tailored per company. Like, you can't kind of come up with one traction metric in a pre-product phase, I think. And also, what I always like in this, when we have these high-paced interactions with founders, where we talk to them on a daily or weekly basis, running up to our IC, it's just to have any sort of exciting update, right? It's like every time I talk to you, I want to have multiple exciting updates. And it's also just a volume thing of the amount of work that you do to show that you're a very good executor.
No, thank you. That makes sense. I agree. It's all about like, what evidence do you have? Just present me the evidence you have. Show me that you have made progress on this, that you know a lot about it. Charlie, anything to add to this one before we kind of move to the next?
Not a whole lot other than I think for the LOI, actually, yeah. So for the LOI perspective, LOIs I think do matter. During the, again, this is my data point here because I've been to many of these during Y Combinator demo day. LOIs do matter, but I think what matters is when investors eventually do diligence on those LOIs, they're going to reach out to those customers, and the customers that have used your product, even in a way that doesn't seem very pretty and it's not fully polished, it's an alpha and that's that enterprise level product. If it's something that said, I can't live without this, that's a lot of signal. Investors will reach out to those customers. And I think having an LOI, that sign that shows that people want it versus then somebody reaching out to that customer and then that customer raving about it, saying they can't live without your product, are two very completely different things.
Yeah, I agree. I'd rather have the potential customer who's just willing to rave. So it's like, would you be a reference for like up to 3 or 5 potential investors? Because it's usually not just one they have to talk to. And that is another time commitment. If someone's willing to get annoyed by potential investors because they want your product to be built that badly, that's a very good sign. All right, we're gonna move on to the kind of next section here. Like making a good impression via a pitch deck. And I should say that, and there was a question here on like first-time founders and how to be convincing. I will say a pitch deck generally has become the industry standard for like something you put together that an investor can like quickly figure out, who are you, what are you working on, like what is it in? And it's a mix of like good storytelling, and it's usually broken out into certain sections, and we have a lot of research on this. And we're going to look at just how much time is spent on these things. So, this is a rough cut for pre-seed. Successfully raised decks, about 4 minutes and 10 seconds. Failure decks, I shouldn't say failure decks. It's just founders who said they were not able to successfully raise now. And if you don't raise, you can always raise again later. It's not like a death sentence. It's just, you weren't able to raise now. And you see a lot less time spent on the ones that don't make it. And we have seen a big increase in the number of 20 and 30-second views of decks where the investor bounces. They don't actually go through the whole thing. It's a little different at the seed stage where, you probably have more evidence. People, even if they don't invest, are spending a little bit more time reading through it because you probably have more to show there. But you're still looking at only like, 3 minutes and 23 seconds for a successful raised deck. So it's not a whole lot of time. So I guess my question for Charlie and Youri is like, given the short amount of time, like what are you looking for, and how can a founder like put their best foot forward in terms of like you thinking highly of them and wanting to take a meeting? Is it like the design in the deck? Is it like the narrative? Is it, and maybe Charlie, you can kick this one off again with like what do you look for, and how does a founder make a good impression in this like relatively short amount of time?
Yeah, I think there's a few things that every investor is going to be a little bit different. There's a few things, and I'll just speak for myself that I look for. I look for a lot of brevity. If you're many words on a deck, many words in a deck usually is a heuristic for there's less things to talk about. So you're trying to find things to talk about. So that's one. I think a second one is having a logically laid out deck. Each slide in your deck should almost be the headline sentence and then the supporting points, whether data or something else in the body of the deck. And so if it flows, if you've shown that customers are valuing your product, if you've shown that you understand your unit economics, if you've launched, if you understand your customers, if you haven't launched, just any type of data points that even shows things that you did not scale or things that you're doing that does not scale just to kind of hack growth, that's all supporting elements of your deck. At the end of the day, I think a lot of investors are different. There's some things that there's resources all over the place for putting together a good pre-seed and seed deck. They're on like ycombinator.com inside of their library. Sequoia has one of those seed decks that's been popular throughout the years. And so I would just say, just go look at those decks and then just don't write a lot inside of your slides. Keep it clear and concise, because brevity usually is a heuristic that it's a heuristic that you probably have there's potential that you're going to become a great founder.
Yeah, that's a good point. I always look for narrative as well. And it's one of those things where if I see a good narrative, I'm like, that's a great narrative, but it's kind of like hearing an awesome song. I'm like, that's a great song. Could I create one? It's much harder to create something that looks like a natural narrative where you end it being like, well, why isn't this a thing yet? you see one, you can recognize it. You're asked to create one as a founder. It's much harder. But to Charlie's point, I agree. It's something worth investing in, because if you create a successful company, you're going to have to hire a ton of people. You're going to have to go sell your product. You're going to have to fundraise again. You might have to sell your business. You're going to have to go on an IPO roadshow. So spending time creating an intuitive and obvious narrative is critical. And one of the most common things I see, in line with your point, Charlie, about like there just being too many words, is founders will complicate things in hopes that they look smarter, and it detracts from the essence of what they have discovered or what they believe to be true. Like what is the pitch, you know? And I always say, don't assume any knowledge on the part of the investor. This should be something that you can go to your parents and they'll be able to like talk about with their friend circle, being like, oh, my child is working on blah, blah, blah. And it's got to be that level of simplicity. If it's like Bitcoin married up with some sort of crypto thing, and then there's a bunch of ML on top, and it's like, I don't know, but to what end? Like, what are we trying to do here? And Youri, it sounds like you might be even for Antler earlier stage on these sorts of things, you know, explicitly not requiring a product to be launched. So does that change like kind of your view on, or does your view differ in terms of what you're looking for? Is there even a deck needed, it sounds like?
Yeah, so first of all, when you apply to Antler, you don't need to have a deck. You don't even need to have an idea. You can actually do it based on your profile as a founder. And depending on what skill set and background you bring, you can even get into one of our founder cohorts without having a complete idea. If you come from a much more, let's say, business-oriented background, it becomes more important to have some kind of idea of what you're actually going to do. And then we do look at decks, right? Also in the application process. And of course, once you get to the investment committee after the first 10 weeks of working with us, then you definitely need to have an awesome deck. But if I just talk about the earliest decks that we see, so those kind of first contact moments, right? Because again, after the 10 weeks, we've also helped to co-create the deck that we ourselves want to see, right? So I think it's probably more helpful here to focus on how do you even get in the first conversation, right? What do you need to put in your very first deck that you do like on a cold blast sometimes, or through some introductions. And I think there's things that I would say, some of the things that were mentioned before are things that if you don't have them in order, like the format and the structure and so on, and the kind of not being too detailed, you basically will just switch off the investor and they will just drop out. They were like, I can't be bothered to even read this. And so those are almost like your hygiene factors that you just have to have in place to even have a chance for them to read it. But then I think you always need to have something which is creating a kind of aha, like something new or new insight or something with the investor where they're like, oh, I never thought about it that way. And then you get them excited and you get them, they start wanting to talk to their colleagues and, brainstorming about it and so on. And so for me, very often where I look for that is on the definition of the problem, because there's way too many problem statements out there that are either, very, very high level, or they're just, full of assumptions, which I can easily shoot at and just seem very, very incredible. So if you're able to articulate in a quite deep way the problem that the customer is having, and that I have maybe never even heard of that problem, but you explain it in a way that kind of makes sense, then that is something that gets me kind of triggered to look at it and be like, okay, maybe you're onto something. And by the way, I haven't heard that too many times before. So, maybe there's not like a whole lot of competitors out there yet. So that might be a good start. And that then brings me to another part, which is always one of these quick things to look for, is kind of competitive analysis, right? Because if you have a either no or very, very simplistic competitive analysis, then it just shows that you don't really understand the market and you don't really understand what you are going to do yourself and how you need to differentiate. But if you're very crisp and you say, look, there's actually these 10 companies, but these 3 are the most important ones, and this is in detail what they do and how we differ and why we can win their customers over, then I think that's also that becomes a good trigger to think, they really understand how to build a business in a competitive world. And last but definitely not least, I'd say the team fit to the idea or the team fit to the problem space is important, because if that fit is really great, it almost becomes automatic to say, well, even if the idea is not great, then at least the fit is great. So they're probably going to find a better idea in the same space. But if it's a very disjointed combination of founders with ideas or problems, you're like, yeah, what do you know about that space, right? And there's probably like 100 other people doing the same thing with more experience in a relevant space. So then that becomes a bit of a factor as well in deciding whether or not to want to have a first meeting.
Yeah, founder market fit can be really important. And as a founder, other areas you don't know as much about seem very shiny and oh my God, there's so much over there versus the thing I'm an expert on. And it's like, there's nothing left. But I think that might be true generally if you know a lot about a space. But yeah, so like try to work on things if you have choice that you have some experience with, because that is something that investors will be looking for. Charlie, anything else to add, especially for founders that maybe haven't been through YC or already built and launched something? Anything they can do to stand out for when you're looking at them?
I think it depends on if if they consider themselves pre-seed, which in my mind is pre-revenue, pre-product, or and then seed, which is you either have the product out in market for a period of time, or you have customers using it, or you're generating revenue over a period of time. I think leverage your networks and get introductions to investors where it makes sense. It always makes sense to get introductions. If you don't have the luxury of getting those introductions, I think reaching out to an investor based on something that could be useful, like for example, if you're going to reach out to Bling Capital and you're a seed stage, we're definitely interested in understanding a lot of data around net revenue retention and then how your engagement cohorts are looking. But if you're a pre-seed company, we want to understand more about how could we be helpful at the earliest stages. If you're a consumer tech or internet and mobile or marketplace, looking at the team's relevant experience and perhaps figuring out a way where it makes sense that we have some experience that could be helpful at the earliest stages. Because at the earliest stages, it's just writing code and talking to users, and you should be experts at your customers at that phase. And then in the next phase, like seed stage, is where you can really rely on some operational rigor and support from people who have seen it before.
Yeah, that's a good point. I'd kind of summarize that to say at the pre-seed, but the more data you've got on your business, the less the experience of the founders matters. And certainly at a certain place, it's like, we don't care who is running it. Well, you still care a little bit, Series B, but like the numbers kind of speak for themselves type of thing. So if you're a founder with less experience, like you want to have founder market fit there. And the more progress you can make, the better in terms of helping to compensate for, I haven't built and sold a company before type of thing. But again, like your deck is going to be scrutinized. So it is important to pay attention to for pretty much everybody. The final area that I want to look at is just the parts of your narrative that matter. And again, it's wonderful, Charlie and Youri, thank you so much for joining, to have more detailed, because this is these are the numbers we've got, but then the commentary brings it to life. But what we see in the numbers, and this is comparing 2019 data with 2020 data. So basically pre and post pandemic. So the pandemic is probably accelerating some trends. Everything is just changing in tech super fast anyway. But what we've seen is when investors spend time inside of these decks, we code the decks to know, like, this is a competitive slide, the product readiness slide, this is a business model slide. We've seen for pre-seed, big jump in the time spent on competitive landscape. So to Youri's point, like, have you at least researched your competitors? Do you have an okay framework for how you're different? Product readiness, people spend a lot more time being like, if you say you have built something, have you built something? What have you built? And then business model. So, what you're seeing, and to Charlie's point, even at the seed round, more companies are having revenue and like metrics, and you see these big Series A's. And the big Series A's are typically not just like vaporware, like they've actually got real businesses. So even at the pre-seed, understanding, well, how well do you know your business model? Because I don't want to like have you figure it out, or maybe you figure it out, but you got to have something else to show for it. And then when we look at the seed stage, we see a giant spike in the amount of time spent on the business model. Like if you don't have revenue traction, cohort analysis, like we at least need to see, as an investor, like a clear conceptualization of what is your business model. If you've got traction in your seed stage deck, that's going to get really scrutinized, as well as your market size. Like, okay, great, you've got some MVP, you've got this, like you're on a tear. What's the TAM? I'm thinking forward to the next round of funding, and then obviously more time spent on the product as well. So this is across a big set of companies what we've seen, and again, during 2019 and 2020. Youri, maybe starting with you this time, what have have you personally had any change since you've kind of been before and after this, like where you spend time, or do you have a view on what has changed about the criteria and where companies get more scrutinized?
Yeah, so I think with COVID coming around, a few things have changed in the reason why people start a new business and the way in which they go about it. I'm just going to try to explain that a little bit. So first of all, some people, they basically they end up getting fired because of COVID, for example, and then they're looking for the next best thing to do, and that could be an interesting story, or they could actually have, I guess the archetype more inspiring story, which is, oh my God, what a crisis! I'm going to change the world now, and fuck all this corporate career stuff, and let's get on it, right? And then that's so I think the starting point of why people are starting on the journey, I think, is quite important, and maybe increasingly more so, because it's just you have a bit of kind of separation of the pack. Then there may be a few archetypes also of how people present the story in that stage. And one is one that's really customer and problem focused and goes very deep in terms of showing their understanding of the specific problem and the idea for the solution and things like that. And the other one is maybe a bit more kind of riding on the trends and projecting kind of 5 years out, 10 years out, this is how we can build a company. So more like, let's say, the roadmap approach, where you say, look, we're going to start with this customer segment, we're going to do this, we're going to do that, then we're going to go next step here. And it's a bit more the strategic visionary type of story. And I think both of those can work, right? But if you see that a person or a founder is really focused on the specific problem and the customer, then it's all about kind of getting an understanding of, is that something that is scalable enough that they're talking about, and are they really the right person to do it? Like, do they really get it? Coming back to my earlier point on the kind of insightful problem definition. And on the other one, on the kind of, let's build a giant company because now we have this big crisis opportunity that we want to leverage on. Then it's, can you explain in an articulate way what are the sequence of events that is going to happen to actually build this company? It sounds a little bit unstartup-like, but I actually do see some great pitch decks which have that kind of big ass vision, which is then built up in a logical way. And that also gives credibility, because then, you still need to get through phase one and you're going to learn so many things and pivot a lot, but at least you have the kind of the end in mind and a really good way to go there. So depending on which one it is, you're going to end up looking at a slightly different things.
That's fascinating, because sometimes one of the key things about interpreting this data around additional time spent, the question is like, is that good? Is that bad? And the answer is that it can vary. If you have a business model that is multi-staged and like tiered, you could be reading it because it's interesting. On the other hand, if you have a business model that's like really confusing, it could be bad. It takes someone a while to like understand what it is. So that is interesting, but it does sound like the business model matters. So founders should be thoughtful about what is in there.
Example, right? Just one example on the kind of longer term one. So there was once a founder, and he came in with a story around sustainability, but it was very abstract. And then I kind of asked him, like, can you make it a bit more concrete? And then came back and he said, well, we're going to design this technology for under like sub-ocean farming. And actually, by doing that, ultimately, we are going to, first of all, increase the food supply for the world, but we're also going to be generating a massive kind of energy supply, and we're going to be, and it was like this crazy visionary approach for a long-term play, almost like something you would hear from like the likes of Elon Musk. But it kind of, it was so structured and solid that you're like, if you're that technical person who can actually come up with that design, it is really crazy, but actually there is a path to get there. And that's something that works sometimes, but that's a very different type of deck than one where you say, here's 10 existing competitors, and let me show you, how today I am already better than them.
Slightly better widget, yeah. Charlie, like, what's your kind of reaction, or what's your thinking around where founders should, make sure they're real buttoned up? As you said before, it should be simple, shouldn't be complicated. So people are spending a lot more time reading these things. Is that because founders are putting too much information there, or how do you think about how founders can make their decks better for your criteria, and where they should be really buttoned up and make sure the slides are the ones they've spent enough time thinking about?
I think there's a few. I think the main engagement point is the deck, and then there's obviously the interactions around that deck. I think the most important thing that founders often miss, and I was super guilty, and also in somewhat I am still guilty of this because it's everyone's always trying to just better themselves, is providing a concise explanation of what you are doing and why, and using very plain speak English. Don't use, if you are using a buzzword, you are not providing a concise explanation of what you do. It should be very, very, very simple and straightforward. And in 1 or 2 sentences, anyone can understand what it is that you do. And the reason why anyone's, because investors don't know much, as investors should not know more about your market than you should. Investors should not know more about your customers than you should. They should not know more about your business than you should. And if you can't distill it down in such a way, then it's hard for the investor to understand your points of view, understand your market, understand your customers. And I think that's a point that many people miss. And I think spending a lot more time on that would be super helpful. Also, and I mean, that just has ramifications across the competitive landscape and the business model and the traction and the market size and the product. Just being concise and using plain speak. I mean, plain English, plain whatever language you speak, but I'm just saying, because I speak English, I'm going to say English. So like plain English, what it is that you do. And I think that ultimately leads to a more successful discussion, which is a precursor to having a successful fundraise.
Yeah, and that ties back to the point around like, make sure your parents can describe it to their friends. And a lot of the 20 or 30 second like views that we saw in our data set where the investor just bounced, my guess is that, Charlie, to your point, they just failed to describe what they did, and then they didn't get, like, the investor didn't even go through. So these are only successful decks that we're looking at here. So, you know, it could also be the case that if you describe what you do succinctly and obviously have a good narrative, then you've earned the right for the investor to go through and actually spend a little bit more time thinking about, does this business model make sense on top of this opportunity that's been found?
Yeah, there's so many heuristics that go into an investor, and it's just based on their experience. I think the longer they've been an investor, the more companies they've seen. I think they're like quick little hacks that the audience can take into account is around business model. Be very clear on what your business model is. Like, we charge X, or if you're a biology company, we do this. If you are like a space company, this is how we will make money. And then when you go on traction, just saying like 20% month over month growth isn't enough, because you could grow 20% month over month. You basically churn the first month of companies first month, and then you grew 20% based on, so just showing like, what does your cohorts look like in your traction, not just those high level single data points, showing that temporal view into your data. And on market size is also very helpful. A lot of companies say we're in a $20 billion market. Well, people spend 20 billion, cool, so that's your proxy spend. But what is your market based on your business model times how many customers you can get from a bottoms up? What is your path to $100 million in revenue? What's your path to $500 million in revenue? What percentage of the total available market are those 2 data points? And those are quick hacks that you can do that just makes an investor's life so much easier. Be like, got it. This founder knows the key pieces to seeing if this could be a successful business. They've already checked that box, and they've helped us understand how this could be a successful business just by those little hacks.
I can just add one more point on go-to-market, actually, because this one often makes it very obvious if a founder understands how the customer actually thinks and how you can get to the customer. So if it's B2B, I love a bit of meat on the bone on what does the sales process look like, right? Which stakeholders are you targeting? How many steps are involved in the sales cycle? What's the lead time between them? Which documents do you need in order to get to a deal? And if it's B2C, it's, where are they hanging out? And obviously, who are they in the first place in terms of segments? And how are you going to reach them in terms of marketing activities, organic and paid? And kind of a certain level of clarity on that goes a really long way. Because if you know who the customer is and how to get to them, yeah, it's much, much more likely that you'll be able to sell them anything.
Yeah, on that point, I often tell founders to just like focus. So they're like, an example of it being too complicated, like, well, we're going to have a product-led self-serve part of the business, and it's also going to be freemium. Then we're going to have enterprise sales, and then we're also going to go through channel. And then we got a partnership thingy over here. And it's like, no. That you're describing like a large public company. Like, what is going to be your go-to-market model that's going to like get you to the next round? Focus on one. And have some conviction around how that's going to work. or not. You can always pivot later, but the one certain way of failing is being scattered across too many things and not focusing. I want to make sure we have time to get to Q&A. And this also kind of ties in with a couple of the questions that have been in here around, again, more questions are like, what do you guys look for? Questions on like, how should founders get in touch with investors? And then, hopefully we can, and then another one, maybe a good one to start on is, given that we're still in a pandemic, it's dragged on for longer, what are sectors that are less attractive or more attractive, or does it even matter for you guys? Like, is a company that's trying to start a product in the travel space, is just now not a good time? Or is it like, no, the time horizon is that, years, this will return? Or like, how should founders think about addressing in their pitch decks us being in a pandemic and that potentially impacting whatever their business is? Maybe Youri, if you want to start.
Yeah, happy to. There was a few questions mixed in there, right? I'll start with the last one.
We can just start with the last one. The pandemic. How should a founder think about, like, your view on the pandemic impacting their business?
Yeah,
Are some sectors just like right out, or you're still kind of like open to everything, but the founder needs to be like kind of conscious of how it might impact them?
Yeah, so no, like, I mean, there's two types of businesses, I think, in the context of a pandemic. One is that they are, based on something that really surfaced or became much more exaggerated because of the pandemic. And then that's often a very, very exciting short-term opportunity, because suddenly you have this gigantic need, which is not yet solved. And so you can jump in there and get a lot of traction really fast. But the question becomes, is it going to last until after the pandemic is over and everything is, quote unquote, back to normal? And the other one is the other way around, where it's like, yeah, we came up with this potentially before the pandemic even came around, and now we just need to make sure that we can actually survive through the pandemic in the first place. Both are, totally okay. Of course, the short-term excitement, it always triggers, right? So I'll give you an example. One of the companies we invested in recently in India, there, as you know, in India right now, there's hundreds of thousands of new COVID cases per day. So it's a really, really terrible situation. But what's super exciting about this company is that they're now actually taking call it the mom and pop grocery stores, the Kirana stores of India, of which there are millions all over the country, and putting them online, right? And there's a few companies doing that, but all of them are quite new. And so the opportunity from digitizing that commerce, which is so in person normally, to be online, which never has been online, the kind of the short-term traction opportunities that you're basically going to get hundreds of millions of customers in a matter of months, right? And that is really, really exciting. And then, of course, you need to figure out competitive edge for the long term, and how the business model will sustain. But I do think that if I were to start a business today, I would definitely look for a short-term hook that is kind of triggered by the pandemic and that immediately calls to the attention, like, wow, we can grab a lot of market share in no time because of this urgency over here.
Yeah, you're right. It kind of depends on the business and how they show up, and then how they kind of represent that and their ability to think through how it impacts the future. Charlie, any advice on your end in terms of how it impacts the pitches or the questions it brings up for you, or even how you advise your own companies on how to deal in this environment?
I think above all, a startup's main goal is to not die and grow. So it's to grow, because if the startup dies, that's it. So if you are impacted by the unfortunate circumstances of the now this endemic issue, the thing to do is just you got to pivot your company into something else. You have to pivot your business model into something else, a different business model, perhaps in the same space or in an adjacent space. Because again, your goal as a founder and your fiduciary responsibility is to make sure that company continues to grow, and also because you want to continue to find ways to help your customers, even if they were existing customers. In terms of where opportunities, there's so many opportunities around the world. I think the most important thing is you need to have an unfair advantage and what those opportunities are as a founder, and then just share those unfair advantages. And those usually are, you've worked in space, you've seen this before. If the pandemic is the catalyst for you starting a company, or for you pivoting into something that you've always thought was an opportunity, but the market timing just wasn't there yet, go for it, rock on, do it. But in terms of like that's really the only, I mean, even advice is bad. Like, don't listen to me, I know nothing. But at the end of the day, you know your customers, you should know your market, you should know the opportunity, you should have a good understanding about the timing. And then our sole role as investors is to just listen, to understand, to evaluate if you're an institutional investor, and then make the fiduciary responsibility that you can as an institutional investor to invest in a company based on whatever mandate you have to your LPs.
Yeah, I think it's a great point that, the rough answer is if your company is not growing and you don't have line of sight to when that might change, pivoting might make sense. I've been helping out a founder who did that, and it's been great. It's scary to pivot, but if you have more information and that information is an unfair advantage and you can pivot what you've got to something better, you got to be nimble as a founder to stay alive and keep growing. Well, we're almost at time here, so maybe we'll end on a note of just for each of you, starting with you, Charlie, like, how can people get in touch with you, and how might people kind of self-judge to know, like, are you a fit to try to get in touch with?
Sure. I would recommend everyone go to blingcap.com. You can learn more about Bling Capital, our solo GP, Ben Ling, the principals. You can learn about our product council. You can learn about our sectors of focus. You can learn about our backgrounds. If you're pre-seed, would love to speak with you. Send us an email at dex@blingcap.com. If you're seed, you have some data, feel free to send it on over to dex@blingcap.com. And again, we have our sectors of focus out there, and we look forward to learning more about your businesses, learning more about y'all as founders, and the good works that you do every single day. And it's a tough job, and so just being in the arena as founders and CEOs, that's you should, that's a tough game. And thank you for trying to start a business. We need more entrepreneurs.
Yeah, agreed. Thanks, Charlie. Youri?
Yeah, so in the case of Antler, first of all, on the website, you can see how we work in the whole application process to get into a founder cohort. I'd say the perfect fit is if you are in a stage where you have a rough idea of what you might want to build, but you haven't yet launched a product, and you also don't yet have a complete co-founding team. That is when we can add the most value, because one of the greatest value adds is that you get into cohorts where you can mingle with a lot of other highly qualified and selected co-founders to meet and form your team. Now, that said, if you do have a complete team and you already have a product, we definitely can still invest. And so in that case, would encourage you to get in touch just over email and see what is a kind of tailored model that we could run with you. But yeah, you don't need to have an existing product. You don't need to have a complete team. If you have a ton of drive and a relevant experience in any area that you actually want to build something in, that's all it takes to get going in the process. So
awesome. Yeah, I love that you guys have such different perspectives and different models, and I think this also highlights that there are a lot of investors out there, and there are a lot of different models in going about it. For DocSend, we do have a free introduction service. We don't invest, but you can send your deck to pitchdeck@docsend.com for pre-seed or seed, and we'll get back to you with feedback. Only about 10% of decks make it through that filter, unfortunately, but you do get feedback at least. And then for the ones that do make the filter, we have a list of institutional pre-seed and seed stage investors that we'll send these things off to a couple times a week. I've gotten a number of companies funded, and that's just a free service from DocSend, because it's, everyone uses us for fundraising anyway, so we try to become a slightly more efficient matchmaker, but there are a bunch of ways out there to get in touch with potential investors. Well, I think we're right up at time here. So thank you everyone for joining. Charlie and Youri, thanks again so much for your time. And then Cassie, anything else to add?
No, this was a really great discussion. Thank you guys so much. I dropped some of our research in the chat, as well as all of this research is possible because we collect data through a survey. So if you want to contribute to that so that we can keep doing this research, much appreciated. And thank you guys.
All right, thanks all.